In 2023, the United States government did something it rarely does. Put an exact price tag on a promise. $138 billion. That was the official estimate, from the administration's own numbers, for a plan that was supposed to quietly forgive student debt for millions of Americans over the next 10 years. No press conference fanfare. No big televised signing. Just a repayment plan with a boring name and a budget line attached to it. A year later, courts had gutted it. Most of the people who planned their financial lives around it got nothing. And the people who built their careers servicing that debt, the companies standing between you and your loan, never missed a single payday. That's the part nobody talks about. Not the trillion-dollar headline number you've heard 100 times. The other number. The one hiding underneath it in the machinery that processes the debt, denies the forgiveness, and gets paid either way. Stick with me. Because by the end of this, you'll understand why student loan forgiveness might be one of the most quietly profitable phrases in American finance. And almost none of that profit goes to the student. Right now, in 2026, more than 45 million Americans are carrying federal student debt. The total balance just crossed $1.7 trillion. That's larger than auto loans, larger than credit card debt, second only to mortgages. And here's the thing about a debt that size. It doesn't behave like a private problem anymore. It behaves like infrastructure, something the economy is quietly built on top of, the same way a city is built on top of pipes nobody thinks about until they burst. This year, those pipes burst. Not metaphorically, legally. A repayment plan called SAVE, designed to let millions of borrowers make smaller payments and eventually have remaining balances wiped clean, got dragged through federal courts for 2 straight years. In 2026, the government and a coalition of states settled. The plan was declared unlawful. Every borrower enrolled in it has 90 days to get out and into something else. So if you were one of the people counting on that forgiveness, restructuring your budget around it, delaying a house, delaying a kid, delaying your life around a number that the government itself estimated at $138 billion, you're now being told politely that the number never really existed. Not for you anyway. That's why this matters right now, this month, not as a historical curiosity but as a live wound. Because the same pattern that just played out with SAVE has played out before. And the people who get hurt by it are never the people running the system. They're the people trying to navigate it. So let's actually open the machine up. How does this system work? Not the politics of it. The mechanics. Here's the part most people skip past because it sounds boring, and boring is exactly where the money hides. When you take out a federal student loan, the government doesn't manage your account day to day. It hires a private company to do that. These are called servicers. Names like Mohila, Nelnet, Aidvantage, Ed Financial. You've probably gotten an email from one of them and deleted it without reading past the subject line. These companies don't lend you money. They don't set your interest rate. They don't decide whether your debt gets forgiven. What they do is far simpler and far more important. They process your payments. They answer your calls. They tell you which repayment plan you qualify for. They are, functionally, the only human-shaped interface between you and a number that might follow you for 20 years. And they get paid for that job the same way a subscription service gets paid. A flat monthly fee per borrower, regardless of outcome. Sit with that for a second. A servicer earns money simply because your loan exists and is being tracked. Whether you're thriving financially or drowning, whether your forgiveness application sails through or gets buried, the meter is running either way. Now, the fee itself is small. A few dollars a month per borrower. That sounds almost quaint until you multiply it by tens of millions of accounts year after year for decades. Small numbers repeated at scale stop being small. That's not a scandal on its own. That's just what servicing a debt of this size always costs somebody. Here's where it gets uncomfortable. The fee structure pays more for a loan that's in repayment than for one that's behind on payments or paused in forbearance, which sounds fine in theory, service the performing loans better. But in practice, it created a quiet incentive. For years, it was financially easier and more profitable for servicers to push struggling borrowers into forbearance. Pause the payments, pause the problem, rather than walk them through the more complicated, more time-consuming income-driven repayment paperwork that might actually reduce what they owe. Forbearance is fast. It's a 5-minute phone call. Income-driven repayment, the kind of plan that actually counts toward forgiveness, takes documentation, verification, follow-up. One of those options helps the servicer's call handling metrics. The other helps the borrower's future. You can guess which one borrowers were nudged toward for years without anyone ever calling it a violation. It didn't have to be a violation. It just had to be the path of least resistance for the call center and the lowest friction option for the script the representative was reading from. Multiply that across millions of accounts, and you get a number like this one. By 2017, one major servicer alone had collected an estimated $4 billion in extra interest, specifically tied to people sitting in repeated forbearance instead of repayment plans that would have actually reduced their balance. That's not theft in any criminal sense. Nobody went to prison for it. It's something closer to a slow leak. A system where doing the easy thing for the company was, for a long time, structurally different from doing the right thing for the person on the other end of the line. Now layer the forgiveness programs on top of that. Public service loan forgiveness was passed in 2007. The pitch was simple, almost beautiful in its simplicity. Work in government or a nonprofit. Make 120 qualifying payments. After 10 years, whatever's left gets wiped out. 10 years later, in 2017, the first wave of applicants came in expecting to collect. 28,000 people applied. 96 were approved. That's not a typo, and it's not a rounding error. That's a denial rate north of 99% on a program that had been running on paper for an entire decade. People had organized entire careers, nursing, teaching, public defense work, around a 10-year promise that, when it finally came due, paid out to less than 1 in 290 applicants. The reasons for denial were almost insultingly bureaucratic. Wrong repayment plan, missing paperwork, a loan type that was never eligible to begin with, something nobody at the servicer had clearly explained when the borrower signed up. The program wasn't secretly malicious. It was just designed with so many small technical tripwires that almost nobody could walk through it cleanly without expert help. Help most borrowers never knew they needed until it was too late to fix. Congress noticed. They created a fix, a temporary expanded version of the program to catch people who'd been denied on a technicality. The fix had its own denial rate of roughly 94%. They fixed the fix, and it was still mostly broken. It took years of waivers, lawsuits, and policy patches before approval rates meaningfully improved. By late 2025, total forgiveness through that program and its offshoots had finally crossed $87 billion, which sounds enormous until you remember it took 18 years, multiple administrations, and a global pandemic-era policy override to get there. Against a total federal loan balance of $1.7 trillion, that's a rounding error wearing a press release. Here's the irony sitting quietly underneath all of this. The system was never short on promises. It was only ever short on delivery. Every administration since 2007 has announced a new plan, a new acronym, a new path to relief. SAVE, PAY, ABR, PSLF, TEPSLF, an acronym for a fix to an acronym, which is its own kind of joke. Each one launched with the same confident tone. Each one ran into the same wall. A system that collects fees on certainty and only pays out on extraordinary persistence. So let's put the hype next to the reality side by side, because the gap between them is the whole story. The hype. Forgiveness is coming. Relief is structural. The government is finally fixing this. The reality. In the program's first full decade, forgiveness reached a fraction of 1% of eligible debt, while servicing fees were collected on 100% of it, every single month, without interruption, without a court challenge, without a single denial letter. The hype. SAVE would forgive remaining balances and ease payments for millions, at a projected cost of $138 billion over 10 years. The reality. Courts blocked it before most of that money ever moved. Borrowers got 90 days notice to switch plans, and the same private servicers who would have processed that forgiveness are now the same private servicers processing the unwinding of it. Either direction the policy goes, the contract holders get paid to administer the chaos. That's the quiet part. Not who wins the political argument over forgiveness. Who gets paid regardless of who wins. Zoom out further, and the implications stop being personal and start being structural. 18% of borrowers in repayment are currently delinquent on a federal direct loan. Nearly a quarter of all federal borrowers have, at some point, been in default. Default isn't a late fee. It can mean wage garnishment, seized tax refunds, a credit score that locks you out of a mortgage for years. We're not talking about a niche population here. We're talking about a meaningful slice of an entire generation of working adults, carrying a debt structure that behaves less like a loan and more like a long-term tax. Except this tax has a private contractor sitting between you and the government, profiting modestly from your confusion every single month you're enrolled. And here's the part that should make anyone pause, regardless of which side of the political aisle they're on. This isn't a story about good guys and villains. Nobody designed this to be cruel. The servicers are running a legitimate contract business with the government. The forgiveness programs were written by people who genuinely believed they'd help. The courts that struck down SAVE were applying real legal limits on executive power, not sabotaging borrowers for sport. But somewhere in the space between a well-intentioned law, a private servicing contract, and a legal system that takes years to resolve a dispute, an entire generation's financial planning got treated like collateral damage. Not by any single actor's malice. By the simple, almost boring fact that complexity is profitable for whoever administers it, and confusion is expensive for whoever's living inside it. There's a phrase economists use for this kind of thing, a doom loop, though that's probably too dramatic for what's actually a fairly mundane spiral. Tuition rises because loans are easy to get. Loans get bigger because tuition rose. Forgiveness programs get proposed to manage the bigger loans. The forgiveness programs get challenged in court partly because of their size, which was caused by the tuition increases the loans enabled in the first place. Round and round. Nobody at any single point in that loop is doing anything illegal. The loop itself is just shaped like a problem that profits the middle and costs the edges. So here's where this leaves us, heading into the back half of 2026. A new repayment system is rolling out this July with new plan names and new structures, built on top of the very contracts and the very servicers that managed the last version, and the version before that. Maybe this one works better. Maybe the fee structures have actually been fixed this time, the call center incentives realigned, the paperwork simplified enough that 99% of applicants don't get quietly turned away on a technicality. It's possible. Genuinely possible. Policy does improve slowly under enough pressure. But here's the question worth sitting with long after this video ends. If the people processing your debt get paid the same amount whether your forgiveness is approved or denied, what exactly is their incentive to make sure it's approved? Nobody in this story has to be a villain for that question to matter. That might be the most uncomfortable part of all.